All right, looks like we're live, guys. What's going on, Craig? What's up, Chris?
What's going on, buddy?
What's
Not
going
too
on,
much, man.
Brad?
Same old stuff. Same old stuff. All right, guys. So today we're going to be discussing credit and what part it plays in getting a mortgage, how it works, and the next steps if credit is or credit repair is needed. So I want to introduce Chris Wisniewski. Did I say that right? Your last name, Chris? Is
Yes,
it
you
Wisniewski?
did. Yeah,
Cool, man. People probably mess that up all the time, huh?
every day.
So Chris, correct me if I'm wrong here. You're the founder and owner of SelectUS, which is a credit company known for individualized credit coaching services for home buyers.
Yes.
Yep. All right, cool. And you're also a recent author of Credit Repair Sucks. I was checking out your website, dude, and I saw you're on a billboard in New York City. Is that true?
Yeah, in Times Square. Yeah, I've been doing a lot of different stuff on Fox, ABC. So, yeah.
That's awesome, man. Kudos to you.
Yeah, brother.
Thanks,
I'm just trying to be like you, man. That's all.
I have a problem writing like a paragraph of information. So, and to be an author of a book, that's a big thing, man.
Yeah, I appreciate it. Thank you.
That's awesome, man. So guys, for those of you that are listening, we're obviously talking about credit repair or not credit repair, but credit scores and how they relate to getting a mortgage. And we're going to go into some credit repair topics here. So let's just start. Craig, maybe you can help me here and kind of talking about how credit scores, I guess, impact the different type of mortgages that are available to consumers.
Well, I mean, there's four main mortgage products that are out there. For the most part, you have what the programs allow credit score wise. For example, an FHA loan, you can go as low as, I believe, in the low 500s, but banks have overlays. And for the most part, banks, including our bank, we want all of the credit scores to be at least 620, and we can sometimes go down to a 600 with an exception. So even though the loan program itself, like FHA, allows for a lower credit score, banks have the final say, and they say, we want at least a minimum of this credit score. So FHA allows for lower credit scores. Conventional allows down to a 620 as well, but it's harder to get qualified with a conventional loan at that lower credit score tier. VA allows down to a 620. I feel like USDA allows down to a 640, but the big part to all of these conventional VA, USDA programs, all programs have to run through an automated underwriting software engine. And if you don't get an approved eligible status or an accept eligible status, you're going to have problems with most banks in getting a loan. So how do you change that? How do you create the ability of qualifying for a mortgage or qualifying for more mortgage products? That's increasing your credit score, right? It gives you a better chance of going through those automated engines. It gives you a better chance of qualifying for multiple products. The other part to credit score is interest rate, right? Interest rates are vastly affected for different programs based on credit score. Conventional loan products are most affected by credit score. So if you're in the 600s, even though you might qualify for a conventional loan, your interest rate could be significantly impacted, especially if you're trying to do maximum financing, up to 95%, up to 97%, or 90% of whatever the purchase price is. So credit score has a big impact, not only on eligibility, but the cost of doing business, right? So, and that's what we're here to talk about, right? Is how can we improve that? Maybe talk about frequently asked questions regarding credit, and maybe some tips on something that you might be able to do to increase your credit score in the immediate future, instead of thinking that there's nothing that you can do immediately.
Yeah. So talking credit scores, I mean, obviously, like you said, it's going to determine what program they're eligible for. It's going to determine interest rate. I think one of the biggest things that hold people back from applying for a mortgage is that if we pull their credit, it could affect them in terms of their credit score, but it could affect them in terms of the program that they're going to get qualified for. And a lot of people, I don't know if you probably get this all the time too, Craig, like where a lot of people want to hold off and wait to boost their credit scores up because maybe they're at a 620 or a 640 and there are programs at that point that they qualify for, but they're hoping to get a conventional loan and they want to boost their credit score up to say a 700 or a 740. So they're going to get more attractive interest rates or a more attractive program. But, and I don't know what you guys feel in terms of this topic, but me personally, seeing what the market has done, right, over the last couple of weeks, a person that, I don't know, had a 620 or a 640 credit score that maybe applied for a loan 6 weeks or 2 months ago might have been getting a better interest rate than somebody that has a 740 credit score today. So in some cases, I guess it could, waiting to get your credit score to that desirable number that you want it to be at could affect you because of the cost of interest rates and how they change often. Do you guys have anything to say about that? Like, what's your, Chris, you're the credit guru here, right? So what is your advice about, applying for a mortgage and somebody thinking their credit score might be lower? Do you advise holding off and working on credit? Like what steps do you think somebody should take when applying for a mortgage that might have a lower credit score?
I mean, a lot of times you see a lot of people, they're guessing, they go into like Credit Karma, they're going onto one of these sites and they're saying, I got 680 or I got 580. Or you hear someone saying, well, my credit's okay. And it's really a 500. And some people say, I think I have bad credit, but they might have a 650. So I always say, instead of guessing, let the lender run the credit. I definitely advise the lender to run the credit because there's also, and you guys know this, you can look at it and there might be also a couple quick fixes that you guys could see right off the bat, and I have it all the time where people will call me up and say, I have credit, and then they get them to a lender and they're fine. They qualify. So definitely have a lender, run in and get a good report.
I think you make a good point there because a lot of people, regardless of what service they use to pull their credit or figure out where they're at, think that the score drives everything. Meaning, for example, they think that somebody that has a 580 credit score is the same situation as somebody else that might have a 580 credit score, but has a lot more delinquencies, a lot more issues that they have to resolve. So I feel like that's important too, is that you got to get out of your head in a sense and thinking that, okay, I have a 580 credit score. I can't do anything right now. And they wait instead of looking at the details on that report, right? Maybe you have 2 small accounts that are causing your credit score to be dropped to 580. And it's not a whole bunch of things that you have to fix right away. So I feel like it's not just looking at credit, it's looking at the details of what's causing your score to be at a certain level. Not everybody's 580 credit score is going to be the same, right? So I think that's important. And what Chris is, talking about here about having the lender pull credit is that, and you tell me if I'm wrong, Chris, is that different sectors of financing have different algorithms used to generate scores, right? Like if I go to buy a car, the score could be different than when you're going to look and pull credit to buy a home. Or if you're going to get a Macy's card or a Home Depot card, that's going to be a different score than what we might generate. So I feel like, and this is a lack of education on the part of how credit is in general. And a lot of these third-party services just want to get you to spend money to just get you a score in general. But really, it's confusing people to me, you know what I mean, on what your score is. But I would say that, can the score be different when you're looking to buy a credit or get a credit card from a department store or a car or buy a home?
Yeah, I mean, there's a ton of different scoring modules. So, I always tell everyone, because I get leads from, I'll get it from a realtor and they'll say, hey, the lender talked to them and they said, their score is not good. I said, okay, well, what was the score? What's going on with it? And they'll say, well, the lender never ran it. So how do we know what the score is? How do we know what the issues are? A lot of these clients that I do see, and this is not taken away from my business, but a lot of them, I tell them, I'm like, you really don't need credit coaching. You don't really need credit repair. These are a couple little things that you could do. and your score will be up there immediately. Now, obviously, some of the clients, they do need my services, but that's why I always have, let's have a professional look at it, break it down, and then say, okay, you know what, we can handle this in-house, or this is something that, we can handle, in a few months, and we're going to, send it over to me to talk to them and such.
Yeah, I agree with all that. And a point that you brought up, Chris, was these online free credit agencies. Like we get that all the time, right?
Yep.
And that sometimes is what's holding people back. And that goes to like what you said, the scoring models. Like it's important, I guess, getting especially if you're calling us, if we're on the phone prior to them talking to you, right, then it's obvious that they want to get a mortgage, right? So we have to figure out where the baseline is, right? So that's why I encourage people, let's do a credit report. And the cool thing about what we do, Chris, you may or may not know this, is we have the ability to do soft pulls where it's going to give us the accurate score and show us the body of the credit, but it's not a ding on their credit. So a lot of times when we have people that, are afraid of the inquiry because they know they have some bad things going on and they don't want one more thing affecting it, then we do have the ability. And at that point, if their credit score is where it needs to be and the body of credit is where it needs to be, then we're like, hey, we're good to go. Let's do a hard pull so we can actually run you through the underwriting system. And Craig, that's a point you brought up, the body of credit, right? Because Chris, your goal is if you talk to somebody, let's get you to a 620, let's get you to a 640 to meet that requirement for the lender. But there might be things on the credit report that come up that have to be resolved, like collections might not need to be resolved, but maybe, there might be something like a judgment or something like that. And it's good to know it now in advance than waiting until the last minute when you are absolutely ready to buy a house and you're pulling your credit to find out you have a $3,000 judgment that needs to be satisfied that you didn't account for.
Yeah. And then also the other thing is too, when you're looking at the credit report, you can look at your own requirements and say, okay, well, this client has a 590. Let's just say you need a 620, but we also need this collection, taken care of because of, it's a $5,000 collection. We're able to look at that and say, okay, now if we settle that collection, would that drop the score? Would it not? And we're able to align it. So I always tell everybody when you're looking at this, have the lender run the credit. Okay. Once the lender runs the credit, the lender then can break it down and say, okay, this is what we could do. This is what we need help with, and then you go from there. This way you have a game plan instead of, like you were saying, sitting there and saying, well, I can't qualify. This is going to take me a year, or, not sure of what you can do and then making a mistake. So that's why I always think it's really important, to have a professional look at it.
Yeah, that's great advice, man. But it's good hearing it from you as an expert in this line of work. And not only that, just a little fun fact for those of you that are listening right now and don't know, Chris, you actually have a background in mortgages. You, like, a long time ago you did mortgages, and so you almost have like two perspectives on this, like the one from the credit expert guy, but also one from somebody who originated mortgages and understands that line of the business.
Yeah, I started actually in '89. It's going back a little while.
You're dating yourself, man. You're not supposed to say that, bro.
Yeah, it's cool. But doing second mortgages and credit, because the second mortgages at that time, you're creeping near 20%. So, if you worked on your credit, maybe you got down to like 13%. And that was like a great rate at the time. So times have definitely changed. But the part of, having the requirements, the score, and, call me old fashioned in my ways, but I do like breaking down a file to say, okay, this is what I'm looking at. How can we get this client to where they need to be, to fulfill their dream?
Yeah, it's an awesome way to look at things, man. Because that's inevitably why most people end up on a phone call with you, right? Because most of your referral partners are in the real estate or mortgage business. So your goal is let's figure out how to get you into the house the fastest and easiest and cheapest, right?
Yeah, we do see, we see if you look at it, about 30%. Okay, if you look at where we're at, we're going through a big boom right now, but about 30% of consumers have bad credit. Okay, and if you look at how many people are out there, that's a huge number. And it comes down to what you were saying earlier, is there's really no education. Okay, there's no education, and that's where I find the importance of really breaking something down and saying, okay, if you want this home and this is what you want, these are steps that we have to do. Because a lot of times people really want the help. And what I hear and what I see is they try to do all these different things and find out that they made a couple mistakes. So maybe they did a couple good and the score went up 40 points, but then they did something that they felt that was good and dropped the score 80. So now they're down 40 points, and that's the financial end, but how about also the emotional end? I think it just hits people where they're like, I don't feel like doing this anymore. I'm not getting anywhere. So I'm just spinning,
Yeah.
So that's why I think it's really important.
Well, and I feel like you're making a great point as why your service is so important, why, your company is so important, because all of us can do things on our own, right?
Sure.
But I feel like you would say yourself, okay, and that's, that's talking about your book too. I feel like you're saying, hey, you can do this on your own, but sometimes you don't have the time in the day. You got 2 full-time jobs, you got kids, you got other things going on in your life. You can cut your own grass, right? So I say to people, you can cut your own grass, but if you can afford it, you hire, a landscaping company, right? Not to say that you can't cut your own grass, but maybe they do things a little bit different. They're experts at cutting your grass, hedging right, making your plants look good. So that's just kind of an analogy of how you help people with credit repair, right? Is, hey, you can do it on your own, but I'm going to make this a lot easier for you. And I know some things because I'm experienced with credit that are going to help you get this done a lot more quickly and save you some time.
I do. And I also think it's, I think a lot of times with realtors and lenders, they miss this part. It's a huge referral base. So when you take someone and they have a family and they're trying to get a home and they can't get a home, they go to this realtor, they go to this lender and they keep getting knocked down. And you're actually able to help them. The credit coach, the realtor, the lender come together as a team and they're able to help them. They're telling everybody because they have friends that are like, well, how did they know the situation? Well, how'd you get in this house? Well, they sat down with me, they talked to me, they went over everything and I got in the house. And they're like, well, you got in the house, I could get in the house. So it's a great referral, but it also makes you feel good knowing that you actually helped someone. So that's what's important.
Agreed. I feel like people appreciate stuff like that more so when you take them out of a situation that they thought they couldn't get out of, and they're going to tell people about it.
Yeah. I mean, if you got a 780 score, you got a ton of money in the bank, it's like, it's expected,
Right.
They're like, well, you're supposed to do this. What else are you doing for me?
Right.
But when you help people, I definitely think it comes back to you. I mean, we get a ton of referrals just from like, hey, you help so-and-so, can you help me?
Yeah, I still have clients to this day from 8 years ago, 9 years ago that still send me praises, birthday wishes, all that, because they're just so happy with everything that we did for them because we held their hand. They're like the most satisfied clients at the end of the day because, we did something that, like a 740 credit score, that borrower that can get a loan anywhere. They just want a loan, right? And there's loyal people, obviously, but the people that can't get a loan, or, the biggest thing is that most mortgage lenders aren't willing to take the time. They're just ready to move on to the next 740 credit score borrower. And that's kind of where we're different, is that we take a hand-holding approach with every client. It doesn't matter where you're looking, what you're buying, or what your situation is. And I think that you definitely shouldn't, look over or look past a client just because they have credit issues. You should work with them. And like you said, team, it's all about team. It's all about picking the right people, like, not to say anything, but if you go to like a bigger company, right, they don't really have teams. Like if you call Rocket or something, they don't have a team. That it's a guy or a girl answering the phone. They're going to take you through the mortgage process, but they don't have, a team of people like the right real estate agent or the right credit professional or insurance agent. So it's all about team, man. So I appreciate you saying that because it's big, it's huge.
Well, it's also a huge pipeline builder that a lot of people miss. Yep. So like you said, a lot of lenders will look at this and they'll say, oh, I'm too busy, and a realtor's sitting over there, they're busting their butt. They're trying to grab, deals left and right. And they're saying, okay, well, how about this client? No, this client doesn't work. This client doesn't work. Let's work with these ones that do work. If you sit back a little bit, you can say, okay, this doesn't work at this moment, but this is something that we could actually nourish within, 1 to 6 months, we could get this client into a house. Next thing you know, you have an extra 1, 2, maybe even 3 deals a month popping because of that pipeline. So you don't see this in the business, you see this, which is huge, and keeping everything going.
Yeah, well, that's all about making it relational versus transactional. I mean, that's what we do, man. We like our people that are credit impaired, we have a system where we're actually reaching out to them every 90 days because things change. And, so having a company or a service like yours that can help us manage those clients and get them to the finish line is important. Let's talk about credit really quick, Chris, because we didn't really dive into it, and it doesn't have to be a long-winded thing. Like, let's just talk about like the main bullet points that make up a credit score.
Well, you have your pay history. Okay. So that's big on how you pay your bills. Okay. You also have your utilization, which is also big. So when you're looking at somebody's credit, obviously, they might have that 590, just utilization might be a 50, 60 point difference right there. Sometimes even 100 points.
So what is utilization, if you can explain that so
sure.
the listeners know?
Okay. So, this happens all the time because people don't realize this. So let's say you have $1,000 credit card limit. And you go to a bank, you get your credit card, and you say, okay, what can I do? Well, you could use $1,000 if you want. Technically, you can use that $1,000. Okay. Now, on the credit score, which they say that'll boost your score, that won't. That'll actually drop your score. It could drop your score up to 100 points. So if you have that credit card, you really shouldn't use more than 20%. And I always have my clients leave a couple dollars on there. Okay. So when you're looking at that, sometimes when you pay a credit card down to zero, that could actually drop the score. Now, to me, common sense wise, it doesn't make sense. But if you leave a few dollars on that card and keep it under 20%, you'll actually see your score spike. The other thing is that a lot of times when you use that, and I always tell everybody when you're looking at credit, you got to look at that on a financial. Credit actually makes you money. You save money in interest rates. When you go out and buy a car, you're not getting hammered over the head. You're saving money there. So I always tell everybody when you're paying a credit card, okay, you pay the credit card, but the second thing that's key is find out when your credit card company reports your balance. A lot of times people miss this step. So let's say the balance is being reported on the 17th. I always tell my clients, make sure you pay that card around the 12th, 13th, make sure it posts before then. So let's say there's a small balance of $10. They report that to the credit bureaus. There's also this misconception that, and you hear a lot of credit repair gurus or what have you on YouTube saying, well, you should pay your card after every transaction every week. The credit bureaus only report, okay, or the creditors, only report your balance to credit bureaus only once a month. So that's why it's always key to do that. Okay.
Yeah, that's great. That's great information because I didn't realize that a zero. I mean, obviously you have to keep it where they're reporting, right? So I always tell people the same. I always tell people 25%. So the 20% number is good. I'm going to start telling people that.
It's actually less than 20%. So don't use more than 20%. So if you're looking at it, so let's just say you have $1,000 limit and you don't have to use 20%. Say you use $180 of it. The bill comes in. Leave $5, $10 on there. Pay everything off and leave a $5, $10 balance. I mean, obviously you have to pay the minimum, but leave $5, $10 on there. By that sitting on there, that will actually boost your credit score.
Yeah, not only that, like I always tell people, so this makes sense to leave $5. I always tell people use a credit card, but then when the payment comes in or the bill comes in, pay it off. That way you don't accrue the interest. Now you're not paying interest because it's paid off right away. So at anything, then you have a $5 balance every month rolling over, which the interest on $5 is nothing. So it's a small cost to ensure that you're building your credit, but you're also at the same time keeping your balance down enough where you're not letting it roll over and accruing all that interest. So,
yeah, but another good point though is that so you could your bill could be due on the 10th, and they might not report that to the credit bureaus to the 15th.
Yeah.
So you pay your bill. Let's say you want to be early, you pay it on the 5th. Okay, which is good. You pay the bill on the 5th, you pay it down. You have say you have $1,000 limit and you run it up to $400. 2 days later. By the time that creditor reports that to the credit bureau, you're now using 40% of that card, which will actually drop your credit score. So that's why it's always key to know when they're going to report also. So you just hold off from using the card. And I always tell everybody that has, a lot of times you'll see people with $500,000, $1,000 credit card limits and they max them out. I mean, you go out to dinner a couple of times and, you go grocery shopping and you can max that card out pretty quick. Okay. So I always tell everybody when you're starting off with credit, you're trying to build that. Your goal is to get the $5,000, $10,000, $20,000 credit card limits. After you get into the home, the $10,000, the $25,000, $50,000 credit lines. That's going to come in time. But when you start off, you really want to use that, that 20% or underutilization because one, it shows other credit card lenders like, hey, listen, this person knows how to use it. We want to give them more money. We want to give them more cards. Okay. So, and it also helps your credit score, which is important.
Well, that's actually a good point that I want to touch on, because it's something to consider. Like if you have a person that has a really good credit score, and maybe they have a balance limit that is lower because it was like their first credit card or whatever the case is, another way to help with your credit score increase or maintaining a higher credit score is just requesting a limit increase, right? I mean, if you had $1,000 credit card, they might be open to increasing it to say 5,000 because of your payment history, right?
Yeah, 100%. And a lot of times they'll offer that to you. So if you go to like Capital One, okay, Capital One will actually give you a line increase, and you're not getting hit with like, a hard inquiry. Now, if you go to Chase and you have like a much bigger limit, they're going to hit you with a hard inquiry every time.
Okay.
So let's touch base on some additional things that make up credit. We talked about delinquencies, right? Making your payments on time, keeping up with your payments, and utilization. What other things, general things that affect credit?
Length is a nice size part of it. So if you just started out with credit, you hear a lot of people say, well, you could get, a couple months, you get 850 credit score. It's going to take time for that. So if you got a card, like you'll see this a lot of times, somebody will get a card at 22, time at 27, 28, they'll close that card. Okay. Once that stops reporting, okay, your length of history drops, which will actually still affect your credit score, which is not good. Another thing is, again, small percentage, like 10% of this is like the mix. Like you have student loans, car loans, mortgages, that like mix will also help your credit. Now to pivot off that a little bit, if you're trying to buy a home, okay, and you're working, you have a couple credit cards, I do not suggest getting a car loan if you don't need it, educational, personal loan, because that could actually drop your score. So once you build your score up enough, then you could start mixing your credit. A lot of people like to go, they get a credit card and then they start trying to get personal loans and auto loans, which can actually drop it. So you
very good point, because I realize that a lot in my experience of reviewing credit is that you do such a good job of maybe starting off building a few credit cards, you're paying them on time, you're keeping your utilization low, and then you go out and get a car loan and they're like, what happened? My score dropped by 60 points. Actually,
they're running the credit like 100 times too.
Right, well,
so
car
that
companies
really don't
are
help.
notorious for doing that. Yes, yeah. But not only are they running the credit a lot, but I feel like installment loans, especially if you don't have the depth, you don't have the length of history to kind of counterbalance that new car loan or any installment debt for that matter, the credit bureaus are going to knock down those scores. I feel like those algorithms in general, just for me logically to think about it, is they don't want you going out buying 3 cars in a row, right? Like if you have a 740 credit score and it knocked your score down only 10 points, you might be able to go to the next car dealership and buy 2 more cars, right?
Right.
So I feel like, or borrow a large amount of money. I feel like unsecured debt, or even if it's tied to a vehicle, you're going to see some lowering of those points if you don't have that history of saying, yeah, this guy's had, or this person has had credit in the past to offset that. So it's not going to drop that score as much if you've had car loans or mortgages in the past.
You also, this is another thing that's a little crazy, but if you have an auto loan, pay off the auto loan and your score will drop because you're closing that account. So in other words, you just spent, 60 months, 72 months doing all this, paying all that. And then once you pay it off, your score drops. I think, to me, credit cards are the key. I'm not really big on installment loans. So when you're looking at that,
Well, that shows you're, I guess, mature or responsible too. Because like car loan, you get the car loan, that's it. You can't do anything. But the credit card shows that you're responsible and you're not maxing it out constantly, right?
Well, that's the biggest factor that most people miss. So when you have a credit card, that's revolving. So as that's revolving, you're using the card. Okay. So a lot of people, I'm sure you guys know this, you'll see high balance. So other lenders know, like if you had that $1,000 credit card limit and they say, well, I ran it up to $800, it actually shows that you ran it up to $800. So they'll see that. Even if you paid the card down, they'll see it. So when you're doing that and it's a revolving, you're seeing a bunch of different things. One, you're seeing how much do you pay on a monthly? How are you paying it? Are you paying it on time? With a car, like you were saying, Greg, you're just saying, okay, well, they pay their payment every month, which it's helpful. It's good. But to me, I like the credit cards instead of mixing it up that much. And, to the point of opening up new credit, look at it as like a diet or a workout. And that's why I try to talk to a lot of my clients. So the first things, let's get some success. So if you're looking to purchase a home, let's get your score to where it needs to be purchased a home. That's great. The other thing you have to look at, in time, that score will continue to creep up if you do the right thing. It's like a workout. You can't go and say, I haven't worked out in 5 years, and all of a sudden in a week, I'm going to look fantastic. I mean, if we could do that, I like to eat, so bring it on. But so I always tell everybody, you can see those quick jumps, 1 to 6 months. To get excellent credit from there, it just takes time. So I always tell everybody, I know you want to get this other credit card, but if you hold off a little bit, you'll notice that you won't get those $500,000 credit card limits. You'll start getting those $5,000, $10,000 credit card limits, which really you could actually start doing things with.
Yeah, man. And then don't forget the rewards that they offer. Like my buddy, he uses credit cards all the time to finance like flips, and he gets, all these different rewards, and he pays them off right away, so that's another thing. Like you said, credit can help you earn money, right? That's another one of the ways that it can help.
I fly first class and I use my points. I mean, I personally use my credit cards for everything. I pay them off, but you get your rewards on there, you build your credit score. So if you ever want to get a line of credit or you want to buy something, your score is already there. It's to me, it's security over everything. Credit, security. You see a home come up, you want to get a home or you want to get a second home, you have the credit, you have that security, you feel comfortable to do so.
Yeah, it's a shame, man. It's such an important topic, sitting here talking to you guys about this. And it always makes me think like all this crap that we learned in high school, right? Like I don't ever remember learning anything about credit. And it's one of the most important things that you can, learn about.
In middle school, they're telling you how to balance a checkbook, which nobody uses checks anymore, but they don't talk to you about credit, right?
What's a checkbook?
Right. And the thing about credit is, the common sense part is if you don't miss any bills, you pay your bills on time, you're going to be good. Okay. What happens though when your credit goes bad? That's where the issue comes into play. The issue is, do I pay off this collection? Don't I pay off this collection? Like you were saying, do I have the lender run the credit and kind of see where I'm at, or don't I? It's a lot of confusion, and confusion causes anxiety and everything else that goes into it. So, credit is a huge piece. And I actually think for, moving forward, credit, will continue being a huge piece of our life.
Absolutely. I agree. Yeah. So what do we discuss here now with credit to make sure we didn't miss anything? Payment history, utilization, credit mix, length of time. I think those are the 4 things we discussed. Is there anything we're missing here, Chris?
I mean, the only other thing I would think of is inquiries, right? But I feel like that makes up, and that gets into our next, topic is probably common myths about credit. I feel like people are so worried about having their credit pull and don't realize how little of an effect that it might have. Not to say that it can't impact you, but it has a lesser effect than these other topics that we've even talked about, right?
Of course, it goes through everything's in moderation. Okay. So go back to the car lot. If you go to a car lot and they run your credit 30 times, that is going to drop your score. Right. If you go there and they run it once or twice, it's not going to impact your score as much as people think. There's also, like I said, you hear YouTube and all the social media today that affects you for years. Okay. An inquiry is only going to stay on your credit report for 2 years. The impact's only for a year. Okay. And we have to purchase. You have to use credit to build credit. Okay. Yeah. So you're going to have somebody, but you do it in moderation. If you're looking to purchase a home, you got to get your credit run. If you're looking to, purchase a car, you have to have, your credit run. Just don't have 15 people run it.
Yeah, and you can run your credit a certain amount of, like, as many times as you want within a certain period of time for the purpose of getting a mortgage, I believe. Is that correct?
Yeah, that's what they say. I mean,
that's what I've heard, but I've never.
I tell people not to chance that at all.
Yeah.
I don't recommend it because the thing is when you say, what, you're fine if you do this within 2 weeks. Yeah. They have 50 people run their credit. They're like, well, my score dropped, and I meant like 4 people, or 2 people, not like 50 people. So
yeah, and that's the thing with credit. And that's how I always explain it to people, man. Like if you're constantly inquiring for all these different types of loans, like if you're a person that comes to me and wants to get a mortgage and we pull your credit, and you're thinking that's going to affect you. It's not. But if that same person wants to pull their credit to get a mortgage, but also earlier in the afternoon, they applied for a car, and yesterday they applied for a credit card. The reason the inquiries are affecting your credit, and correct me if I'm wrong, it's because those people are more likely to obtain a new loan after they get this current loan because they're constantly applying for loans, right? And that's kind of us assessing risk, is going, hey, since you keep inquiring, now your score is dropping because you're a riskier borrower, because you're more likely to take on another debt after we offer you ours that could potentially affect you paying this debt on time, right?
I always say one step at a time. So I'm like big, you'll hear me say that a lot to my clients, that, you know, if you're looking to buy a home, let's focus on purchasing a home, because, you know, you might not look at, but if you purchase a new car because you want a new car, spring's coming up soon, you want a new car, and say that payment's $400, now that affects your debt to income ratio, which can also affect your, you know, the purchasing power. You know, a lot of clients are like, well, how does that make any sense? And I'm like, well, that's the formula that goes into, you know, purchasing a home. So I always tell everybody, you know, just try to hold off, purchase the home, and then you go to the next step. The other thing is, a lot of banks too, moving forward with your credit, when they see everyone run your credit, they'll actually shy away from lending you money, because a lot of people say, well, banks, lending institutes, they don't want to lend. No, that's their business. They want to lend. But like you said earlier, you know, there's a risk into that. So they don't want to see you buying 3 cars, you know, like co-signing, and, you know, what you see, like a lot of people say, I co-sign for my daughter, it's not a big deal. That also affects you. So I always say one step at a time. If you're purchasing a home, stay focused on that. And then, you know, after you do that, then you can move on to the next purchase.
Yeah. And I agree with all that. And that's, as from a lender's perspective, we look at 2 things, the credit score and the body of the credit. And that whole debt to income ratio is going to come into effect with the body of credit. Like you said, taking out those extra loans for car payments or what have you. Talking myths, common myths, paying off collections. That's a big one. People just rush into paying off collections because it's a bad thing, right? What's your take on that? Good? Is it good or bad?
Well, here's the thing. Credit's done into an algorithm, like we were discussing earlier. The other thing, it's set up in buckets, okay, which a lot of people don't understand how they score that. So let's just say you have a collection and it's from 2016, okay? It's $80. You're thinking about in your head, I want to buy a house. I have this collection here, you know, it could be medical or what have you. And they say, you know what, let's just pay it. I want to clear my credit. By doing so, now you just updated that to a 2022 paid collection. So no one's looking at your score. No one's sitting there writing it down and scoring you. It's not like a teacher. So everything's done to a formula. So now it sees a paid collection in 2022. That's going to plummet your score, sometimes up to 100 points.
No,
now, on the other side,
I agree. And I feel like a lot of that too, you can identify by when a collection was last reported, right? So there's certain data on the report. You can kind of, as a lender, we can look at, okay, when was a collection last reported? Or, you know, if there's other things that are on that credit, we're referring them to somebody like yourself, you know, and saying, hey, you need some advice. This is why you shouldn't do it on your own, because you doing it on your own, you don't know these certain things. So,
well, that could throw them back. So like, let's say they have a 600 score, and let's just say it only dropped you at 50 points. Now you're at a 550 credit score. So it's like you're going down, you know, it messes with you psychologically, because you're like, come on, man, I'm like getting like kicked here all the time. And then on the other part, you lost 50 points. So that's why I'm big when it comes to collections. Okay. If it's been sitting on your report for a while, paying that could actually hurt you. Now, let's say you get a new collection. A lot of people really don't understand. They give up their consumer rights. When you get a new collection, okay, and you have 30 days to validate that. Most of the time, what happens, you have bad credit, you get a new collection. What do? We throw it in the mail. We're not even looking at it. We're not answering the phone. They know this. What that does now is it makes this a real collection. Goes on your credit report. Since you didn't validate it, it's got to be real, right? That's how they look at it. So if it's a collection that's not reported on your credit report, you need to call them and settle that as soon as possible. We also handle settlements and things like that in-house. But if it's not on your credit report, address it. If it's on your credit report, it's been sitting there 4 or 5 years, you know, I usually would not settle that.
I think the good thing is that there's people that can give you good advice. So before you do anything, it's talk to your lender, talk to your credit professional so that you don't impact your credit score that you work so hard to get to a certain point after, building it for a long period of time or a short period of time.
Well, going back to what we started from, do we talk to the lender? Do we talk to the credit person? Who do we talk to? That's why, to me, it's always important to talk to the lender, because the lender is going to pull tri-merge, which is, it's going to give you all 3 reports. They're going to look at it and say, okay, here's what we have an issue with the credit score. Okay. And for us underwriting, these are a couple of things that are going to come up. So these are things that need to be addressed. And this is how we're going to address them. You come in with a game plan. Again, going back to a diet or a workout, when you're just throwing things in the air and you don't know what's going on, it's so much better to have somebody, a professional, that, is going to handle that for you. And I could be wrong saying this, but you guys don't charge for this. Somebody sends you, an application, they say, I want to buy a house. You guys basically do this at no cost, right? To review the file.
It's not even at no cost. It's costing us. So like when we run somebody's credit, there's a cost to us. So we believe in this so much and want to help people so much that we're willing to make that initial investment for you or for them by pulling their credit. It's not like we're charging people for that.
And they're getting the advice, they're getting the direction and everything, from doing that. And they'll know the steps to be able to get into that home, which is important. It's what they want.
Yep, I agree. And that's the approach we take. I mean, we're going to look at the score and we'll know right away if they need to increase their score and if we should send them for credit repair. But at least at the very least, we could start going, hey, based on the body of your credit, here's some things that regardless of your score, you need to fix. So it's definitely always good to have that strategy call first with the mortgage professional. And then at that point, take that next step for credit repair if you need to. Right. And like you said, there's a lot out there. Like, I don't want to throw any people under the bus or companies under the bus. So I'll they'll remain nameless, but there's companies out there that will take you on, charge you a monthly installment fee. And at that point, they have no incentive to fix your credit because you're paying them $100 every month. Right. So like, I know a lot of people that have had horror stories with credit repair. And that's where, from my experience, you're different, because not only do you not take advantage of people in that way, but you'll tell them right up front, like, look, you don't need to do it. Like you mentioned earlier, just do these few things and you'll be where you need to be at.
Or I can't help you. And, it's the funny part about it is I'm not a big fan on credit repair. I think that most of the stuff that you see out there and see on social media, I think most of that is, it's all BS. A lot of times it's dispute letters and everything else like that. I mean, can you send a dispute letter? You can, but you can kind of do that yourself. Yeah. It all ties into what the purpose is. People want to buy homes. They want to be able to go to a store and feel comfortable when somebody says, hey, listen, you're getting like 20% off by applying for this. And they're like, no, I'm good. They know in their head that they're not going to get approved for this. So it makes them, feel bad. So to me, I think credit's big because it's security. It gives you that comfortable feeling of saying, you know what, I'm okay. I'm good. If my car breaks down or something happens, I'm good. So security to me is important. And, that's with the credit. But the other thing is, like, you'll hear a lot of times, like, let's say credit repair companies, they'll say, well, I could get you to an 800 credit score. Or, we talk about like, doing different things, like even like you could buy a trade line, you see that. And they really don't do it for the consumer. They're doing it for their pocket. Yeah. I'm a big fan on, if we do it for the consumer, gets help. They see the growth. They see the scores go up. They're able to purchase things. That opens up the whole door for the referral-based business, because they're going to refer people to you.
Yeah, absolutely.
Yeah.
That's awesome, man. So you mentioned something, back to myths. You mentioned something, and I'm not really familiar with this, on our call the other day. CPNs, I think you said CPN numbers or something or other.
Yeah. So again, this goes back to, I guess because I'm a little old here, you go back to like all the social media and everything you're hearing. So it's a credit privacy number. So it basically mimics the Social Security number. It's a 9-digit number. So someone will say, hey, listen, for $1,000, $1,500, I could wipe your credit clean. All they're doing is giving you another number that looks like a Social Security number, which actually is illegal, and you get yourself in a lot of trouble. And you guys know this. You guys aren't going to take it. Nobody, their lenders are going to use this. So it's basically a waste of money. It looks like, you're going to have, this new credit profile, and, you're going to have this 800 credit score, but you can't buy anything with it. So it's a waste.
So what you're saying is that they're encouraging people to do this, and then they're saying, hey, this is what you like. If they came to us, they would apply using that number, which then we would find out, because we validate everything, that it doesn't match their W-2s or social. So immediately there's going to be a red flag that that's not their social, right? Is that basically what you're saying? Or kind of like reinventing another social security number in a way for purposes of a credit score?
Yeah, I mean, it's a scam it's illegal, but you hear about it all the time. I mean, I have clients that call me up and they say, well, I spent X, Y, and Z on this CPN number and this was going to wipe my credit clean. I'm like, no, this is your Social Security. You have a CPN number, but you can't do anything with it. They're like, what did I pay for? I'm like, you didn't pay for anything. You wasted your money.
You should have used the CPN number to apply for all the loans you were planning not paying back, right?
I mean, yeah. I mean, it's something that you hear a lot. The other thing is trade lines you hear,
Yeah.
And people use them, which to me, I think that they should be illegal. They're not. Okay. And this is what happens too can I touch on this? Is it okay?
It's everything, dude. Whatever you want to talk about,
cool.
Man.
So what happens is, and I do hear this from other people in the industry. They'll say, well, I'll get them a trade line. So there's two ways to this. So one, they get a trade line, which you could actually sell your credit. Okay. Which a lot of people don't realize this. So you sell a trade line. It's a short-term thing for 3-4 months. So let's just say you're working with a client, you sell them a trade line for $1,000, $1,500, $2,000. Okay, that's fine. The trade line only lasts for, say, 3 months. Now, 3 months later, that client, and I'm just using, examples here, finds a house. What's going to happen when you pull that credit? That trade line's not on there. So what happens to the credit score? Credit score is down. It's not up like where it was. So that's something that is not illegal. I think it should be, but definitely shouldn't be used. What I think the alternative to that is, okay, let's say you're working with a bar that doesn't have any credit, or they have limited credit. And they have a family member, a spouse, somebody close to them. And let's say they had a credit card for 10, 15 years. It's been in, great history, never late. They really don't use the utilization. They're not using it that much. Okay. You can actually add on as an authorized user, which you guys know that will actually boost the credit score. Yep. So there are things that, I always tell everybody when you're doing this, it goes back to designing the right system for these consumers to do the right thing. Okay. So there are things out there. So the CPN number, the trade lines, adding these on, it's a waste of money, but it's also a waste of time. There's other things, alternatives, like adding as a family member or friend as an authorized user. You can do that where you can piggyback and, get the score from there.
Yeah, we've had a lot of clients, we've given advice to do that, but we've also had a lot of clients that had already had that set up.
Yeah, which helps you.
Yeah, so I think we covered a lot today, Chris. Is there anything that we missed that you would like to add to today's presentation?
I mean, we all go through stuff in life. It's something I tell everybody all the time. If you're looking to purchase a home, have a lender run your credit. Okay. Look over the credit. And then from there, we could design a plan for you to get you to where you need to be, and like I said, the big thing is just to not panic, just, have professionals look at it and be able to direct you the right way.
What's the worst that could happen? I tell people, you pull your credit and we can't do anything, or you're in the same position you were before we pulled the credit, right? So you're worried.
A little bit. I actually think you're better, because now you're actually talking to professionals that are saying, well, you know what, you're here. This is what you need to do to get to the next spot.
That's my point, is that they feel like no is going to be the answer, but it's not just no plus a game plan to get you to yes. Whereas if you do nothing, you have no game plan. You have no answer. You got to start somewhere. You have to take action. You're not, like you said, to go back to the analogy with working out, you're not going to get healthier or get in shape by looking at weights. You actually have to do exercises and lift weights, so take action and do something and get a game plan. And then you'll feel a lot better and you'll get less anxiety because you've took action to deal with this stuff. So super excited we had you on, Chris.
Yeah. Thanks for having me.
Yeah, dude. So, me too, man. I appreciate it. You're a wealth of knowledge, man. And just to mention a few things that at our group at Acre Mortgage, the Brondt-Cook group, we are all about creating a clear mortgage plan. So Every single application comes in. Craig, you can attest to this. We have a consultation regardless of what your credit looks like, regardless of what money you have saved, regardless of how much you make. You're going to leave that consultation with a clear mortgage plan, and you're either going to be pre-approved right away or you're going to have strategy, right? And as far as getting credit repair in the mix, is it needed? And we're going to usually determine that because Craig might be able to tell you right away a few things right off the bat. Hey, pay this credit card down, as you were talking about, Craig, utilization. Craig's going to give advice. But if it's beyond that advice that Craig can give, if it's just too much, maybe a lot of collections, then at that point we can refer you over to Chris and his team, and they're going to take care of you. Just quickly, I just want to give you a quick shameless plug here. If you guys are looking for credit repair, if you know that your credit is not, where it needs to be at, you can reach out to us. We'll do a soft pull, and then we'll make an intro to Chris. If you want to go straight to him, in the bottom of this, there's 2 programs he has, SelectUSLLC.com. You can sign up for credit coaching, and he'll, pretty much help you. His team will help you get your credit where it needs to be. Or creditrepairsucks.com. I love that title, man. It's awesome, bro. Only you would have a book named that and be on a billboard in New York City at Times Square, bro.
That's awesome.
Yeah, I had to do it.
But how about an email or anything? Or do you have like a hotline or an email in case they don't want to use websites that they can reach out to and get somebody on your team?
You can email me, Chris@SelectUSLLC.com.
Perfect,
awesome,
man.
Yeah.
And then guys, if you're watching this and you know somebody that, could benefit from this presentation, please feel free to, number one, like it, comment if you'd like, and also share it with your friends, family, coworkers, or your Facebook audience or YouTube, wherever you're watching this. Give us a shout out. Unless you guys have anything else to say, I'll let everybody get back to their day.
Awesome.
All right, cool.
Appreciate
So
it,
thanks for showing up, guys. We'll
Thanks.
talk to you soon.
All right.
Thank
Thanks,
you.
Chris. Appreciate it,
All
man.
right. Take care, guys.